Are you ready to take control of your financial future? Are you tired of living paycheck to paycheck, wondering where all your money goes? Do you dream of financial freedom and security? If so, then it's time to start investing, and the sooner you start, the better. You might be wondering, but I don't have a lot of money. How can I even start investing? The truth is, it's never too early or too late to start investing. In fact, the earlier you start, the more time you have for your investments to grow over time. This is known as the power of compound interest, and it's a key reason why investing early is so important. By making the decision to invest now, you'll be taking control of your financial future and setting yourself up for a more secure and prosperous tomorrow. But it's not just about the money. Investing also helps you diversify your portfolio and mitigate risk, giving you peace of mind and the freedom to pursue your passions and goals. In this video, we'll explore the importance of investing early and how it can set you up for a lifetime of financial success. From the basics of investing to the benefits of starting early, we'll cover everything you need to know to get started on your investing journey. Welcome to 9 to 5 Finance, where we discuss smart finance and investing. Let's dive in and see why investing early is crucial to your financial well-being. One of the main benefits of investing early is the power of compound interest. When you invest, your money has the potential to earn interest, and as you continue to hold onto your investments, the interest that you earn can then also earn additional interest. Let's say that John starts investing at age 25 and contributes $100 per month into their investment account, earning a hypothetical annual rate of return of 8%. By the time John reaches 65, their investment will have grown to be worth around $227,000. On the other hand, let's say that Mike waits until age 35 to start investing and also contributes $100 per month, but earns the same hypothetical annual rate of return of 8%. By the time Mike reaches age 65, their investment will only be worth around $163,000. So, by starting to invest just 10 years earlier, John was able to end up with almost $65,000 more in their investment account, all thanks to the power of compound interest. This is just one example of why it's so important to start investing early. The earlier you start, the more time your money has to grow, and the more you can take advantage of compound interest. The second importance of investing early is that it allows you to take advantage of the magic of dollar cost averaging. You invest a fixed amount of money at regular intervals, regardless of the price of the investment. By consistently investing over time, you can buy more units of the investment when the price is low and fewer units when the price is high. This helps to average out the cost of your units and potentially increase your returns. To illustrate the power of dollar cost averaging, let's again compare John and Mike. John starts investing $100 per month at age 25 and continues to do so until age 35, while Mike waits until age 35 to start investing $100 per month. Over the next 30 years, both individuals earn a 7% annual return on their investments. However, because John was able to take advantage of dollar cost averaging, their total investment grows to $303,256, while Mike's investment grows to only $246,597. That's a difference of over $56,000, all because John started investing earlier and was able to benefit from dollar cost averaging. Another benefit of investing early is the ability to take on more risk. When you're younger, you have more time to ride out potential market downturns and recover any potential losses. You can afford to take on more risk in your investments, potentially leading to higher returns over the long term. For example, let's say that John starts investing at age 25 and decides to allocate 80% of their portfolio to stocks and 20% to bonds. John earns a hypothetical annual return of 10% on their stocks and 3% on their bonds. Over the next 40 years, John's portfolio grows to be worth around $1.1 million. On the other hand, let's say that Mike waits until age 45 to start investing and also allocates 80% of their portfolio to stocks and 20% to bonds. However, Mike only earns a hypothetical annual return of 8% on their stocks and 2% on their bonds. Over the next 20 years, Mike's portfolio grows to be worth around $400,000. In this scenario, starting to invest 20 years earlier allowed John to earn higher returns and end up with a much larger portfolio. This is because they were able to take on more risk in their investments and had the time to ride out any potential market fluctuations. Furthermore, investing early gives you the ability to take advantage of employer matching contributions. Many employers offer 401k or other retirement plans that match a certain percentage of the employee's contributions up to a certain limit. This is essentially free money that can significantly boost your retirement savings. For example, let's say that John starts investing at age 25 and their employer offers a 50% match on contributions up to 6% of their salary. John decides to contribute 6% of their salary, or $300 per month, into their 401k account. John's employer then adds an additional $150 per month in matching contributions. Over the next 40 years, John's 401k account grows to be worth around $1,050,000. On the other hand, let's say that Mike waits until age 45 to start investing and also has an employer that offers a 50% match on contributions up to 6% of their salary. Mike decides to contribute the same 6% of their salary, or $300 per month, into their 401k account. Mike's employer also adds an additional $150 per month in matching contributions. However, due to starting 20 years later, Mike's 401k account only grows to be worth around $400,000 by the time they reach 65. In this scenario, starting to invest 20 years earlier allowed John to take advantage of employer matching contributions for a longer period of time and end up with a much larger 401k account. This is yet another example of the importance of starting to invest as early as possible in order to maximize your retirement savings. One final benefit of investing early is the ability to have a longer time horizon for your investments. When you have a longer time horizon, you can afford to be more patient and potentially take on more risk in your investments, since you have more time to ride out any short-term market fluctuations. In conclusion, investing early is crucial for a number of reasons. Number one, it allows you to take advantage of compound interest, which means that your money has the potential to grow exponentially over time. Number two, the earlier you start investing, the more time your money has to grow and the more wealth you can potentially accumulate. Number three, additionally, investing early can help you diversify your portfolio and mitigate risk, as you have more time to weather any market downturns. And lastly, it's also important to remember that investing isn't just about making money. It's about building financial security for yourself and your loved ones. By starting to invest early, you can set yourself up for a more stable and secure financial future. So don't wait. Start investing today and take control of your financial future. If you found this video helpful, please be sure to give it a thumbs up, leave a comment, and subscribe to our channel. Sharing this video with your friends and family can also help to spread the word about the importance of investing early. Together, we can all take the steps necessary to secure our financial futures and achieve our long-term goals. Thanks for watching. We hope to see you in the next video.